The meeting of October 28, 2023 is now beginning. The agenda is the first item. Well, first, let me welcome those of you for being here, all of you, and staff, and PFM. Welcome to you. Any public comments? Well, let's go around and introduce ourselves. Bill, start with you.
Bill Moore, citizen, member of the Finance Committee.
George Elmore, committee member. Jack Warner, citizen volunteer.
Michael Coner, Finance Committee. Michael Coner, Finance Committee.
Let me start over here.
Good morning, Rick Patterson with Raymond James, Frank Lato, Citigroup, Doug Draper with B of A Securities.
Stephen Lennigan, Wells Fargo.
Okay.
Oh, thank you.
So Leon, you're next up here.
So we got to get.
Okay, I think I'm next. Richard Pengelly, PFM Asset Management.
Leanne Evans, School District Treasurer.
Christy Price, Treasury Department.
Laura Howe, PFM Financial Advisors.
Kristen Barr Garcia, Office of the General Counsel.
Good morning, Anna Patricia Morales, and I'm the Deputy General Counsel.
Welcome all. First item is the COP 2023.
Okay, we do have a couple of people attending virtually as well.
Oh, okay. I'm sorry. Who?
That's okay. Mrs. McQuinn, board member, is here. Heather Frederick, our CFO, is joining virtually. Robbie Cox from Siebert is here. TJ Whitehouse is here from Chase. Can you click right there so I can see? There's a lot of people joining by phone. John Generale from Wells Fargo. Now go up the other direction. We skipped one. Jim Cook. Okay, now go the other way. I think that's Laretha McIntyre from my office. I think that covers it. If there's anybody else online that I didn't mention your name, let us know. I just wanted to read the names into the record. Thank you all for joining us virtually. We really appreciate it.
Guys, you're here. Welcome.
Hey, Leanne, it's Mike Baldwin from Jefferies. Thank you.
Hey, good morning.
How you doing, Mike? Okay, so back to the update for the COP 2020.
Okay, so for the COPS issue, we're going to go back in time to last October when we came to you and authorized the issuance of the 2023A COPS issue. We haven't done those yet. We're getting ready to do it now. So we had a year delay with it. The projects that we were financing included 2 elementary schools that the students are going to move into holding schools. The holding schools are currently occupied by 2 other projects that were financed in 2022, but they're delayed. They're running long. We had delays with concrete, switch gears, generator, HVAC equipment. It was supply chain issues. So those schools were running about 6 months behind. It's the first time we've ever not opened schools on time. The concrete comes in, you have to order it months in advance and only so many truckloads at a time and at 3 a.m. and there's pretty ridiculous schedules to get concrete. Switch gears, we've had to change our whole process for construction now. We used to hire an architect and a contractor, and then they'd work to get the design ready, and then when they're ready to go, we got the contract. Now we go in with a phase 1 to authorize the contractor to buy switch gears, generators, to order concrete, we're calling them long lead items. We need to get the purchase orders ready. It takes 18 to 24 months to get some of the equipment and materials we need. So we weren't ready to borrow this debt issue, so we postponed it. 2 reasons. One is I didn't want to borrow until we needed it, and the second was the longer we had to delay these, the more the costs went up, and I didn't know how much to borrow. So we did not borrow for these. We didn't do the 2023A COPS issue. We do have those projects. One of them is now, there's 3 elementary schools in the transaction, along with a core expansion. One of them has already started construction. They're about 2 months in. The other 2 contracts are going to the school board in November to be approved, so we have final budgets. So we're lining this up right now. And I know we're talking about timing with the banks after the meeting, but the tentative idea was at the end of November, early December. That may change, but we are lining up to do the debt issue in the near future. Nothing else has really changed, except we're only doing the 2023 A's. 2023B was a taxable issue, and it had one project in it. It was Roosevelt Full Service. That contract's not finalized yet, but we've now added in a Roosevelt Phase 2 and a Delray Full Service Phase 2 that's expanding the scope. It'll be done as separate construction projects. Right now, I've got those funded in sales tax. I'm going to ask to move them into the COPS issue so we do them all at the same time. So I'm trying to plan this out to make the best use of funds and get the best possible price. So we're moving ahead with just 2023A. We took this back to the school board because the documents were considered old. So we took it back to the school board last month, but nothing else has really changed. We took the not to exceed down to 165 million because we've taken that project out. But otherwise, we're still planning to do it the same way. I'm actually hoping to try to squeeze some of this long-term debt and make it shorter. One of the things that we're working on right now is some very long-term planning. And those of you that have been, all of you have been on the committee for a long time. You know that we did a bond issue back in 1986. Those schools start turning 50 years old in 2036 and 2040. And we have a lot of schools in the pipeline that will probably need to be replaced in the next 20 years. So I'm trying to adjust the schedule for these to make sure that we have plenty of capacity to borrow for all the construction that we see coming up that will happen after I've retired and new people take over. But I want to make sure we've got a clean slate for that work to happen. I don't plan on being here until 2040. So I just wanted to let you all know that the COPS issue is now moving forward. When we come back in December, we may have the results because we may have priced by then. We may not. So we'll let you know on the timing, but it's going to be right around that time frame that we're issuing. We don't want to get too close to the holidays, but we're trying to get this debt issue done. So I just wanted to give you an update on that so that you know. If you remembered, we did it a year ago, and we're just now getting ready to move forward. It's going to be 165 million is the par.
Yeah.
So this chart was set up with A and B.
So the B is the blue part?
The blue is the, yes, and we're not doing that right now. We're going to do that in 2024. We're just going to pick up the 2023s. There were 5 projects in this when we originally did it, when we brought it to you, and I'm not sure the project list was even here. It was the 3 elementary schools. It was Pine Grove, West Riviera, and Winbrook, and there was a core expansion at Timber Trace, and then the other project is Riviera Beach Prep / North Tech. That one is not ready. They're still working on the scope. We're not ready to borrow for that one. I also believe that it's probably going to end up being taxable. So it would be grouped together with Roosevelt's and Roosevelt Phase 2 and Delray Phase 2. So we'll have a taxable transaction and a tax-exempt transaction in 2024. But the one we're working on right now is 3 elementary schools and a core expansion. The project budgets add up to about $148 million, and with par at 165, just to give us flexibility with the structure at pricing, depending on what investors are looking for.
So the school system that is expanding right now, particularly with elementary?
These are replacement schools. But we have built, we have opened in the last 2 years, we opened a new elementary school, Blue Lake, and we opened a new middle school that was West Boynton, and the high school, Dr. Joaquin Garcia. Those last 2 just opened this fall. So we do have some growth. We grew about 800 students this year. So we did have some growth. But these schools in this transaction are replacement schools.
I see.
So I just wanted to let you know you all have previously approved it, but I didn't want you to be surprised when I come back at the next meeting and say we finished it. It was delayed for good reasons. So we're moving forward with that. Any questions?
Should we approve this again? Had we approved it previously? Or?
You approved it previously.
Okay.
I'm just bringing it really as an update because
okay.
we're just now moving forward with it.
Good enough.
Okay, and the next item is the bank contract. I just wanted to give you an update. We had talked about that we were getting ready to do a solicitation. We did an ITN, and that was completed. The winning bank was Wells Fargo. and that was our previous bank. We did make some changes, and that has facilitated a change in the investment policy we'll see later today, later this morning. The main district bank account, we are using a sweep, and if you're involved in banking, you've heard of a sweep before. Instead of leaving the money in the bank, every night it's being swept out to a money market and automatically invested. So that's a common tool to use when interest rates are a little higher. We've been in a low interest rate environment for so long that nobody was using that product. And now that we're in the 5% for short-term rate, for short-term money, it makes sense to use a tool like that. So I'll talk more about the investment policy change in a little bit. But that was the significant change with the contract. The prices did come down a little bit. I was surprised and very happy with that. So, but everything is in place, and we've moved forward with that. So I just wanted to give you an update. The contract's for 7 years. So we're in good shape. Now we're coming to items for approval. So we have the quarterly investment reports, and we have two. We have the ones for September, and we have September and June, because we had to cancel a meeting. We haven't met since April. It's been 6 months since I've seen you all, so it is good to see. Well, the badges, I think they expire every 2 years, so we will have new ones for everybody at the December meeting. What I thought we would do, we can, for the June, and Richard can confirm that we were in full compliance in June. I don't know if you want to go through the June, we can, but it's really dated at this point. I'd rather spend time on the current report. I see nods and we've had to do this before. So I'm going to open up the September 30 report, and I'm going to give the clicker over to Richard and let him do this market update and talk a little bit about what's going on.
Okay, good morning. We'll jump in to talk about the market. We are still very focused on inflation, as we spent this year and all of last year talking about. But it has continued to come down off of the 9+% highs. Last year we talked a lot about the shift away from it primarily being driven by goods as people were at home hitting that buy button when everyone was under the lockdown to the recovery period post-pandemic or post-lockdown where everyone's getting out. We had revenge travel. Everyone was getting out and doing the things they couldn't do during the lockdowns, and we really saw an increase in services inflation. That's really largely continued where the services component, which is more labor intensive, has driven a lot of the inflation that we've seen as that's become, the tighter labor market has become more entrenched. That's made the inflation stickier than the Fed thought it would be. You remember they said, well, a lot of supply chain issues were really kind of snarling things up, and that was why inflation would be transitory. They had to eat their words on that. But nevertheless, over the past year, we have seen improvement in inflation. Looking at the latest inflation readings from the past couple months, headline inflation is measured by CPIs at 3.7%, which is still very much above their target of 2%. So they've continued to communicate a very hawkish position. They've continued to keep interest rates high, trying to bring the inflation down to their target of 2%. One component that's been driving that number is the shelter component. Numerically, it represents about 30-something% of the actual calculation of inflation. If you look at the high level of the number combined with that, that weighting, it represents about 2/3 of the increase inflation that we've seen. So about 2.5% out of that 3.7 number. But the way it's measured in CPI, it has a lag on it. If you look at more instantaneous measures, inflation really looks like it's very close to that target, particularly if you're looking at PCE. So if I look at the core PCE numbers over the past 3 months and average them, the Fed has probably within a quarter or half a percentage point of its target inflation. So, all that says that we're likely to continue seeing that number come down. And if there was some way to sort of instantaneous really measure the economy or measure inflation in the economy now, we're probably closer to the Fed's target than the measures are saying. So, kind of on our way to talking about labor here, what does a consumer look like? Well, all the built-up savings that occurred because folks couldn't get out during the lockdowns, they've pretty much gone through that at this point, right? So all of that, building or increase in savings has gone at this point. We've seen the student loan repayments have now started again, or in this month here in October. Household debt service as a percent of their income is back to where we were pre-pandemic. So, we seem to be out of that sort of reservoir of spending that could potentially continue driving inflation from where we are here. Looking at the labor markets, so most of the year we've really focused on how wage pressures, tight labor conditions are driving inflation. Here we kind of look at these two things together, and if we compare, the level of wage growth compared to the level of inflation, we can see that both are trending back towards where we were pre-pandemic, where we had sort of wages growing at a level that was higher than the level of inflation. The wage growth level is still a little bit elevated, but again, the trend is back towards where we were before, and it's now exceeding the level of inflation. That being said, we did have some strong numbers come out, kind of indicating that conditions were still, tight. The non-farm payrolls number, the last one for September, came out at 336,000, which was almost double what the market was expecting, much stronger number than expected. The unemployment rate, ticked up to 3.8%. But we have seen the number of folks quitting jobs come down. We have seen the number of open positions relative to the number of people looking for jobs also come down. So, sort of a mixed bag on that front. GDP, the latest reading came out and was very strong, 4.9%, very strong number. Depending on what you're looking at, I think my Atlanta Fed app was saying it was going to be, in the 5+% range. The consensus of economists were someplace in excess of 3%. So, again, depending on what you were expecting, it was either right what you thought it would be or much stronger. But overall, generally, the consumer continues to be strong, despite the elevated inflation levels.
Richard, if I could interrupt for just a second, I wanted to let the committee know Paul Dumars has joined, so we do have all the committee members attending today. So thank you very much for joining, Paul.
Great.
Welcome, Paul.
So, the school district is a short-term investor. So, we were hyper-focused on the Fed and the Fed rate. After their September meeting, they continued to communicate strongly that, rates are going to be higher than maybe the market was expecting. The market has sort of gone back and forth on whether it thinks the recession is going to come in the early part of next year or early part of or latter part of next year. Earlier this year, we thought it would be the latter part of this year. So that sort of evolved, whereas the Fed has continued to communicate that it's looking at the data and that it's going to keep conditions tight until it saw, much more movement on inflation. So, they revised up their outlook after their June meeting. They thought that the Fed funds rate would be lower by 1% by the end of next year. They revised it up and said would likely only be down by 0.5 percentage point by the end of next year. They also revised up their 2025 number the same amount. So sort of reinforcing that view that they're going to keep conditions tighter for longer until they push that number down that inflation number down much further. They also revised up their overall GDP expectations, which is consistent with the actual number that we did see here for the third quarter. They also revised some of their numbers on the unemployment rate, sort of a nod to expecting that maybe labor conditions will sort of remain where they are here for longer. And if you look at sort of where their view is on the path of inflation, or how long it's going to take them really to get that number back down, they're projecting well into 2025 having these inflated inflation numbers. There's been a lot of talk and discussion around the yield curve. The yield curve has flattened out significantly over the quarter, driven by the longer part of the curve. So while the Fed is communicating that it could be on hold for the remainder of the year, the rest of the curve is sort of doing some of its work for us. And a number of things are driving this. The Fed's communication that it's going to keep things higher for longer. Also, the Fed, the deficit came out, close to $2 trillion. So, several things are sort of pushing the upper end of the yield curve up and flattening the curve. Moving into, sectors, we did see over the course of the second quarter a tightening in yield spreads. Yield spreads had widened out in the early part of the year, driven by what was going on in the mid-sized bank market. But we saw that tighten up. That actually represented a good buying opportunity for corporates. They tightened up, which contributed to performance both in the second quarter and the third quarter. We did see a little, or more recently, we have seen some widening out of spreads this month, which is creating a little bit of a buying opportunity in that market as well. In terms of returns, returns were good for the third quarter. If you look at treasuries, 0.74%, corporates were 1% in the 1% range returns for the quarter. So good returns for the quarter. So I'll jump in to talk about the district's portfolios. As Leanne mentioned, for the second quarter, everything was in line with the policy. Same thing for the third quarter. The longer-term portfolio continues to be short of duration. Over the course of that increase in short-term rates, the duration was allowed to drift in, which kept it short of the benchmark. And as a result of that, the portfolio did very well versus the benchmark. As we kind of look at that point where, we look for shorter-term rates to sort of stay level for a while or start to come down, we'll look to move that duration to neutral versus the target. And in terms of returns, quarterly returns, 0.97 for the portfolio versus 0.74 for the benchmark. And over the course of the past year, it was 3.39% return versus 2.47%. Starting to really reflect this new, much higher interest rate environment that we're in. And again, a year ago, 2 years ago, we were substantially lower than this. So thank you, Fed, for that, at least. So I'll pause
Bill?
there. Yeah.
Oh, no, I just, tell me what's the duration of the portfolio as a whole?
It's 1.28 years for the longer-term part of the portfolio.
And obviously, we've benefited from the inverted yield curve. I guess the question is not that long-term interest rates would it make sense, or do you consider increasing lengthening the duration in order to, at the offhand chance that perhaps the inversion will end relatively soon? So in other words, are we giving, I mean, it's obviously a smart thing to be short right now.
Right.
But, and I don't mean short literally, but short, have a short duration. But is that really, do we think about that? Is that something that's I'm sure Leanne's, it's foremost in her mind, but I wonder, is this something that y'all are, is there a price to be paid for lengthening? Is there? I know that maybe in the very near term there would be, but it might be a thoughtful idea to extend your duration.
Yeah, and that's exactly what our thought is. So we're at the point of the year where tax receipts are going to come in. So we'll be working, with Leanne on sort of looking at the cash flow analysis. And our view and bias at this time is that this is the time to start putting some of the new cash coming in out to bring the duration closer to benchmark. The benchmark duration is 1.75 years, and the long-term portfolio is at 1.28 years. Right. The long-term portfolio represents a very small portion of the overall cash. So you've got plenty of buffer in the cash that you kept, that you have short. You have more than $1 billion that's going to be short. So yeah, this is the environment over the next 6 months.
I'm not talking about any significant change, but I mean, maybe if you're what, a year, 15 months now, you move it out to 18 months or 16 months, or a short adjustment in order to be sure we can preserve these attractive yields, and offhand chance the short end, some serious problem occurs and the government intervenes and brings short interest rates down, or should the Fed and the Treasury and so forth intervene?
Yep.
Bring short-term rates down. In other words, I'm sure that's foremost in your mind, but it's certainly something that from my perspective, I'd be real interested in.
Yeah, one of the things that we're looking at right now, we usually, at this meeting, well, actually usually in September, we would have gone out and done a TAN and borrowed money to deal with short-term cash flow issues. We haven't had that in a couple of years.
Right.
We're really in a really good cash position, more so than we've ever had. I'm actually having discussions with Richard. We're looking at investing more money now. We always ladder the portfolio. So securities, we buy a lot in December when tax revenues come in, and they mature, and then they mature as we need them. We have excess cash right now. A lot of it's because of the sales tax. The sales tax is coming in a lot faster than we can spend it. It's just, that's just the cycle we're in there. There's extra money there. There's our reserves are higher because of the ESSER funds. We've been using ESSER funds to pay for things like textbooks and setting the money for textbooks aside to be used in another year or two. So it's not going to be there forever. It's a short-term window that we have. And short-term, I'm talking over a couple of years. So it's not really short-term the way we usually talk about short-term. But over a couple of years, we have extra money. So we're looking at investing and what we should invest now versus what we would do in December. I'm evaluating the core portfolio. Should we be putting some more there? But knowing it's only for a couple of years and then it's going to come back down, just trying. We're tinkering with a lot of things. When we look at the district portfolio, there's a chart I usually show you that shows you the cash flow projections, and I looked at they don't make sense right now. I took the page out. You'll see it again on December 1st. We're going to bring it back in December. because I want to show you what we're doing with cash flow at that point, because we're looking at a lot of different moving parts right now, and it's not what we've dealt with every year. It's different than what we've seen in prior years. So as Richard said, we are looking to do some investing now, probably put a little bit more in the core portfolio, and it can't be the sales tax revenues because that's going to be used up, but our contingency, as our budget grows, that board contingency that is a long-term reserve, it has grown. So I think there's room to add some to the portfolio, but we need to do some due diligence and look at it and break it down. I don't want to add money into a core portfolio and invest for 2 years if I think I'm going to need it in a year. So it's really looking at when I think we're going to need that cash again.
Right.
But that's the conversation we've been having. You know, what do we need to do short-term, long-term? How do we need to move things around? Because just because the management of the portfolios, the core and short-term, in my head, a lot of times I think it's static. We don't change those amounts. But every once in a while, we say, we need to change this. We need to add more money in the core just to make sure we can take advantage of what's in the marketplace, knowing that we're not going to need that. We don't think we're going to need that cash. At the same time, we make sure we're investing in really solid securities so that if there is some reason to dig into that core portfolio, if we had a hurricane, that's when we tap into that. So we don't want to put it in something that we could take huge losses in, but could go out longer. So we are having a lot of good discussion on that, and I'm hoping to have that wrapped up before we get to the December 1st meeting. And that's when tax revenues are coming in. It's just, we also, every year we run into a problem. In December, all the money comes in, and a lot of the companies that are putting things out, they stop issuing. So it's hard to buy securities. So we're trying to buy more early to make the December problem easier. We'll see if that works out. And I wish we could do it every year, but we can do it this year. So we're really digging in on that right now.
These are not small changes, are they, by comparison with normal years, as far as the increase in the?
I've never had a year this time of year when I'm showing that we have $1.6 billion in cash.
Money, right.
We've never had, it gets that high, but then it runs back down, and it's staying up right now because of, there's a lot of grants and a lot of things flowing through, and the sales tax is a big number too. There's a lot of things that are happening that makes my cash flow predictions a lot harder. I always say our cash flows are very easy. They're very cyclical. They're easy to manage. They're not right now. There's a lot of things that are unusual that aren't as predictable. So we're being very careful in how we're doing the investments. I don't want to invest too much and then have a request for money that we need and that I didn't know about. So it's trying to figure out what that level is that I need to make sure is liquid and available and what we can put out longer.
But I think you're probably looking for the high side, aren't you? More money in the long, as Bill had.
Yes. I mean, that's not where we're at today. That's where we're going to be probably by December.
I think I'm.
You're done?
Yeah.
Okay, so I need the mouse back. Thank you. And I'm going to flip over to the district one. Let's see if I can find the right one. We have a lot of documents.
This one,
Let's see, not that one,
wrong one.
not that one. There we go. So this is the district's investment report. And again, I mentioned we have $1.6 billion. We don't usually have that much money in September. Makes my job a lot more interesting, honestly. So it's comprised of 4% cash, 73% money markets, and LGIPs, and 23% securities. We will be increasing securities, taking money out of money markets. And the money markets actually have a really good return right now. It's just looking longer term, and we do have thresholds as to how much we can have in money markets. A lot of that is actually associated with debt and things that aren't governed by. We can have up to 50% in money markets and 25% in pools. So we're right at that limit. This is one of the things that with the investment policy, I need to raise the limit on money markets, and I'll walk through why when we get to the policy. Actually, I may walk through it in the process of this conversation because I think it fits right in. But the core portfolio had that return that Richard talked about, 0.97 versus a benchmark of 0.74. Interest earnings for the first quarter of the year were $21 million versus 5.4 last year. Interest earnings for FY '23 ended up at 71 million. So that was a big number, much higher than projected. That is also a help. It helps with a lot of that is sales tax. Sales tax got a lot of interest earnings this year. So did the general fund and across the board. So Treasury Department's paying for itself right now, and thanks to the Finance Committee, we have a lot of good tools in place. Property tax revenues, they're going to start in November and December, so there's nothing exciting there. Sales tax collections, I'm going to skip this note because we have the sales tax report attached. Here's all the reports. This is just showing interest, and you can see the blue line is what interest was last year. You can see when interest rates really started ticking up, and we hit that 71 million for interest earnings last year, and I expect we'll exceed that this year. We're on par to exceed that. And let's see if I can make this a little bit bigger. There is a button here somewhere to make it bigger. Oh, maybe I can just see it here. So I have a hard time reading it. Here we go. View. Oh, you got a shortcut? Okay, that's great. Okay, so we've added, thanks to Christy Price, who's sitting next to me, we've added some color coding here, which has been very helpful to show where the cash is versus money markets and securities. This is the total portfolio, which is the almost 1.6 billion. And we do have a lot in overnight. We're looking to put a lot of that to work and put it into securities, but it's earning a great return, so it's not hurting us sitting there. We just know we need to lock in some rates before the Fed starts making reductions in rates, if they do that. This is just the graph showing how the money is diversified, and then we have all the list of the individual securities. This is what we're managing in money markets, bank accounts, what is in securities, all of it together, including what PFM has, is all here. There is a change with the bank. I mentioned we talked about the contract. We are now taking all the money that's in the district's main bank account, and it's being swept to a money market. So when we get to the investment policy right now, the limit on money markets is 75% total, no more than 25% with one issuer. The sweep is going into a money market fund called All Springs that's run by Wells Fargo. When you get to December and that tax revenue comes in, and we get $750 or $800 million in a day, and it may be more than that, we can't get it moved out fast enough. We will be over the limit in money markets, in that money market for a day or two. So when we get to the investment policy, I have this threshold staying the same, but for the individual issuers, I added a note that if it is a money market that's utilized with a sweep service, that it could go up to a higher percentage for a day or two due to, I think I put large transactions that are in process. You know, a payroll for us is $70 million in a day. And when you talk about property taxes and doing investments or a debt service payment of $100 million, it could easily throw us over a limit for a day or two. So I don't want us to be out of compliance with our investment policy because of how we manage our cash on a daily basis. So you'll see that when we get to the investment policy. I want to spend a minute here on the sales tax report. We have received $1 billion. We've crossed $1 billion in sales tax revenues. We're $1.05 billion at this point versus the original projection of $844 million. So we're well above. Our average is at about 125% of our original projection. Expenses are at $858 million and purchase orders are 124. So if you add those together, that gets you to, $770 million, but I have over $1 billion in cash. That's part of the excess cash that we have right now. We're urging construction to move as fast as they can. We used to have a line of credit that has lapsed. It ended in July, so we don't have that anymore. We don't have a need for a line of credit. We have the cash. Construction department is working to spend as quickly as they can get projects moving. But we do have excess cash right now. Total interest earnings, net of the fees with the line of credit, are currently at $27 million. So that's money that's available to be used for construction projects as well, which is important Construction costs are escalating dramatically. We're going to need every penny we can get to finish every project that's on that referendum list.
I mean,
Yes.
on that, Leanne, are those starting to slow down also, or are those still going up at the pace they were?
They're still going up. The high,
They're going up, but at what pace?
well, we don't issue projects every day, so I see them between, for example, when we awarded the amount of money we spent for, I'll use the high school that just opened. The total project budget for that high school was $105 million. Sarasota Schools is getting ready to borrow money, and they've told, the last time I talked to them, which is about a month ago, their budget's $175 million. Orange Schools is doing one that's over $200 million. I mean,
Same size school.
Sarasota's is over 200 now as well.
it's over 200, so the costs are escalating. The Orange County Schools is larger, Sarasota is about the same size as ours. So the costs are going up, and it's not just us. We're seeing it everywhere. The construction costs are pretty, it's exponential growth.
And concrete was going up exponentially higher than most. That seems to have at least started to,
Well, it shifts from one commodity, and I'm
Right.
probably using the wrong term, but one commodity to another. And the other thing that's really going up is labor costs. You know, trying to get people to work on the construction job, and they want a lot more money. So it's across the board, but the spikes, we see the big shifts in cost. It was concrete, then it went to steel, was going up dramatically. And every time I go to a construction oversight review committee, I hear what the new topic is for today, what's going up now. And some of those costs are going up because the labor costs associated with manufacturing the items. So labor is a piece of it, and materials. Supply chain, I think a lot of that has been taken care of, but there's back orders. The fact that we have to order, and switchgear, I had to find out what a switchgear was. A switchgear is your circuit breaker in your house, but for a school, it's a wall. It's in its own room. I got to see the one at Blue Lake at Garcia. I got a tour, and the project manager said he's never had anybody ask to see a switchgear. I wanted to see the switchgear, the generator, and all the things that I hear about that cost so much. Those things, it takes a long time. It takes 18 months to get those. Used to be able to order them and have them in 6 months. So everything takes longer and they cost more. So that's a recurring theme. And we're trying to figure out how to get a handle on it, but it's not something that we can control. It's just trying to stay on top of it. Another reason why the borrowing's delayed, I wanted to make sure we had hard costs. We knew what it would be. Because if I go and borrow too early and then the costs go up, we have to figure out how to fund the difference. And I like to have the school wholly funded out of a borrowing if we're doing it that way. Any other questions on the investments?
Nope.
Okay,
Great job.
thank you. Thank you. A lot of good things with PFM. I would mention we did I'm on the investment advisory committee for the Florida Palm, for the local government investment pool, and PFM is the investment manager there, and they did a due diligence tour for the board of directors and investment advisory committee. So I got to go up and see their office, which was really nice. We had a long meeting with their head of compliance that really dug deep into what they do to make sure all the data is secure and safe. It was really enlightening. It was a good meeting. Plus, I had pull-asides with people that I needed to talk to, people at arbitrage and some of the accounting treatments and some of the other things. And Richard was very gracious to set those meetings up. So it was a busy day. I fitted into my vacation, so it worked out well. Okay, so if we're done with that, I want to move on and start looking at policies.
Okay.
I actually have these, they're in PDF and online, but I have them in a Word document in case we need to make changes. And you have hard copies of these. I want to start with the investment and cash management policy. And we've looked at this policy before several times. It hasn't gone to the board since 2017 because the changes that we've recommended have been very minor. And I'm going to show you some of those. When I get, I think page 2 or 3, you can see some of them. Let me make sure, let's see, it may not be showing it. Let me make sure it's showing all the changes. Nope, all markup. Treasurer is capitalized. District is capitalized. A lot of the changes are just grammatical and minor Scribner's changes.
Okay.
So I'm going to skip over a lot of these. And I want to point out a couple of things that have changed, some of which were changed previously, and you've seen them before, but I want to mention them again. The maturity limits are measured from the date of settlement. That wasn't clear, but that makes sense. We've added that in here. This is Florida Prime. This is the old SBA. It was standalone all by itself, and we eliminated that, and we've rolled it into the local government, the pools. It is a pool. It didn't need to be standalone, so it really doesn't change anything. It's just a presentation, different present.
Well, I think the reason we had it was because it was a risk pool as we saw it.
Yeah, it's being managed very well at this point. Federated is running it, and very transparent. All the data is available online. I'm very comfortable using them. We do have notes in here under the pools, and I'm getting out of order now. Actually, I'll circle back to it because I don't want to miss something. When we
Okay,
get to
go
pools,
ahead.
we have language regarding
Now,
Florida
do we have a
Palm.
black line of that, or is that the only one? Do you-
Well, the other thing we've changed here is just correcting the language for the bond ratings. And we've added interest-bearing checking accounts. It wasn't there. I think it was just understood that we could do it, but I wanted to add it in the policy just for clarification. This is taking out Florida Prime, but it comes back in, and I'll show you that in a couple of minutes. The next thing you'll see in here probably is the supranationals. We had a very detailed discussion about that a couple of years ago, and the recommendation originally was 25%. The committee said, let's take that down to 10%, and limited it to, and I thought I took this out. The committee recommended using only World Bank, IFC, and ADB. Oh, it's here? Yeah. Okay, so it's just these. That was something the committee wanted. They wanted to limit it not to all supranationals, but to specific ones. So I'm assuming you all are still okay with that same language, but because we spent 2 meetings reviewing that back in 2019. It's a long time. Seems like yesterday, but it was a long time ago. Interest-bearing checking accounts, we've added that in. That's just pretty basic. It should have been there all along. And I'm going to get down to pools here. Well, money markets first. So this is the change I suggested on money markets. I'm not changing 75% of the max, and it's 25% may be invested with an individual issuer, but I've added a sentence, if a sweep to a money market is utilized as the investment vehicle for the district's main bank account, the maximum for that fund may be 50% for 1 to 2 days only. This is why it's in words, so that I can make changes if we need to. For 1 to 2 days only, if necessary to accommodate large transactions. So it would never, I don't want to ever have 50% with a single money market long-term. It may be for a day or two, because we can't get the money moved out fast enough from one fund to another. When we have large transactions, we bring the cash in the day before, because if we have an investment and it's in a pool or a money market, or it's in securities, when it matures, it goes to our custody bank. They get it around 2 in the afternoon, and then they have time when they have to turn it back to us. Sometimes it's end of day and we can't get the money moved fast enough. So we always move it to where it's ready to go the day before, so we'd have a lot of money sitting in the bank, now swept to a money market overnight. So it's really to accommodate those large transactions. That's why I said for 1 to 2 days only. So it's for a very short period of time. It's just mechanical. I don't know any other way to make the process work and still do the things we do. So that's why I added it as we have the ability for 1 to 2 days to exceed and maybe have up to 50%. And it's really December. It's when last year we received $800 million in one day. I couldn't get that placed in time. It just takes time. So that's why I said 1 to 2 days. So that was a change that we made to accommodate the change in the banking contract.
Could you turn off the sweep temporarily?
Then the money would be uninvested. So it'd be said, have $800 million sitting with no interest, not interest bearing.
I understand.
I don't know if the bank, I think the bank does that. It's a monthly thing. They had to turn it on at the beginning of the month. So I don't know, and I see our bankers sitting over there. I'll have to circle back to find out if that's even possible, because I know it's a process. It took 3 or 4 days to get it turned on. I'll circle back with you and let you know if there's a way to do that. I hadn't asked that question, so thank you for bringing it up. Maybe that's a solution.
And then the other option would be just to be out of compliance.
Yes, I could just be out of compliance. I really don't like to be out of compliance. I don't want to go into a situation that we're building a policy that we know we're going to have a day or two that we're out of compliance in.
I understand. It would, being out of a compliance, though, would raise a flag,
Yes.
so we'd know it.
Actually, you probably wouldn't know it unless it happened at the end of the month, because all the reports are printed as of the end of the month. We're tracking every day. The reports that we monitor, I think I brought in once the Excel file we use to do cash flows, and we are tracking every single day to make sure we're in compliance. The reports that we present are monthly, and the transactions I'm talking about happen in the middle of December or in the middle of June. So technically, I could leave it, know I'm out of compliance for a couple of days and be in compliance, but that's not the intent with the school board. The school board's looking at the policy. They want that policy to be covering everything. So I will talk with the
Isn't
bank
it a matter
after.
of notice? I mean, just having notice of it, that you know?
Well, I don't know what day, I don't know how much we're going to receive from the tax collector until the day before.
I see.
We know,
Yeah.
at this point, I don't know when we're getting the money. They haven't released the schedule yet. Once they release the schedule, we'll know what day it is, but I don't know how much I'm going to get. So I'll work with Richard and and his team, we'll come up with a plan of what we're going to invest. But until we actually get the money and we know the night before, I don't know how much we really have to send to them. So we can't have transactions layered up and ready to go because we don't know how much we're going to receive. So that's the busiest day of the year for us when that money comes in. And it's a busy day for their desk. That was one of the reasons I was so happy to meet the people at the desk, because they said, oh yeah, you're the one that sends us, that we have to deal with this in December. And they can't always get it all invested. Sometimes they have to just buy treasuries and stick it in treasuries until they can buy commercial paper or agencies, depending on what our plan is. So it's a lot of money that comes in to be invested very quickly. If the money came in gradually over the year, it would be so much easier, but that's not the way property taxes work. So I'm trying to put something in the policy that would allow us to be in compliance, which is what the board wants. If I was out of compliance for a day or two every year, the Auditor General would find, our Inspector General would find it. I mean, it would be found. And I'd rather have something in the policy that allows us to stay in compliance.
How frequently will this situation occur, Leanne?
Once or twice a year. It'll be December and maybe in June.
And it would be for 1 or 2 days at a time?
Yes.
Will we know after the fact that it has occurred?
Not unless I tell you.
Well, of course.
Honestly,
Of
it's in a spreadsheet. Now, the Inspector General may come in and want to see it, and we can show it, but it doesn't show up in reports.
Well, we'll
Mrs.
show-
McQuinn has a question. She's our board member.
Thank you, Leanne. If, let's say, then after this policy is adopted, that you go to day 3, what happens?
We would make,
Versus-
it shouldn't take 3 days. It shouldn't take 3 days. It's usually 1 to 2 days at the most. And in the past, the money has been sitting in the bank. And when the money sits in the bank, I'd have a call from Wells Fargo, why do you have $1 billion in the bank? When are you going to get it out? We're used to moving it pretty fast. It's never 1 day, though. It's never, we can't get it all done in 1 day. It always takes 1 day, maybe 2.
You know, that makes perfect sense to me. You know, I'll be paying close attention in the meeting with this. So I want you all to know that I'm actually following all this.
Thank you very much, and we appreciate you being here.
I'd like to know when it happens.
Okay.
And I think, obviously, you would like to know.
Well, we track it. I looked at last year, and we have, on our spreadsheet, we track how much money is in the bank every day. So last year, it was sitting in the bank, and we could see how much money was in the bank every day, how much was in each money market. We're tracking it in very granular level of detail. The difference is that it's not going to be just sitting in the bank this year. It's going to be swept to a money market. I can have 100% of it in the bank. I can't have it that much in a money market fund. And this would be one fund. That fund is only used for this account. I don't have All Springs for anything else. So it would be that one fund that would have a lot of money in it for one day.
Single fund?
Yes, that's why I have this limit on here. It's the sweep automatically, the bank balance is automatically swept to one account. Who's,
It's
That's so good.
it's a Wells Fargo proprietary fund.
yes.
Is it good to have it all in one?
A sweep can only go to one fund. And that's just the way the sweep works. It is a bank account, and every night the money goes to a money market, then it's pulled back as we need it. It's just a function to, instead of having the money in the bank account and the bank investing it, they're putting it into a money market overnight, and then we pull it back. And Ms. McQuinn has another question.
Without being too specific, can you give just a general amount of money that would be if we just left it in the bank versus letting it sweep?
Well, last year, it was $775 million. For
There
that
we
one
go.
day.
Okay, thank you.
It may be higher this year. I never know. It depends on when property owners pay their taxes. Do they pay early? Sometimes it's spread out. Sometimes we get a very large amount. Sometimes the amount the tax collector's sending us is so large it's broken into multiple wires. It just depends on when they get it.
I think there's, at this point, my interest, just as I said, is not having it be something that is occurring mechanically and is not flagged, it's not noted.
Monitored, yeah.
That's all.
Well, if it's in policy, and if I put this in here, I mean, I can certainly report to the committee. If that's something that you all want to see, I can bring that back to you and say that I will have it, we track it, it's available. I can tell you that on this day, we received this much money, and this is how much was in the account overnight, and it was all pulled out the next day.
Well, maybe to the board and to us, just.
Yeah, I'd feel better if
Notice.
if we knew, as I said.
Okay.
And after the fact is fine.
Okay. Yeah, I can certainly let you know. We are tracking it. Irvis in my office tracks it every day. We have a very large spreadsheet, and we're monitoring those every day to make sure we're in compliance. I'm just thinking ahead. We've already tested it and know we'd stay within the 75% that's allowed in money markets. It's the individual fund limit that we would be over for that day or two.
I didn't have any thought that you didn't know. Just since you're discussing it with us and since we're approving it,
Right.
I'd like to know.
Well, and so here's another thought. We're trying to move the policy forward to get it to the board as soon as possible. We wanted to move it forward and get it into the board in December. We could say, we want to wait until January. Let's see if I can make it work without this change.
If it makes your job harder, then I would say, leave it the way you've proposed it.
Okay.
And get it to the board.
Okay. It just gives us the flexibility for a day or two that I don't want to be out of compliance with board policy.
Well, can't you just make a policy in addition that you're going to give notice when this happens to the board and to the committee?
Who else asked the question? Ms.
Me
McQuinn.
again, it's McQuinn again. So, if the committee agrees to put it forward as is, as Leanne has presented, does it work for the advisory committee for Leanne to let you know, the committee know, and then later, if the committee says, I'm not comfortable with how many times or the amount that it happened, then, worst case scenario, you ask that it be brought back to the board for a change. But go ahead and get the policy in place. Just a thought.
I can add a sentence here that indicates that when this happens, notice is required to be provided to the Finance Committee at the next meeting.
Oh, I would say immediately, aren't you?
Oh, immediately?
Aren't you talking about immediately? Okay. Or is it okay?
At the next meeting is fine with me.
Okay.
I would say at the next meeting or earlier.
Okay.
That way it gives you the flexibility. If you just want to notify us prior to the meeting as part of your meeting announcement.
Not later than, not later than the next meeting.
Okay.
Okay. have 25.
I think it was not later than?
Yeah.
Not later than?
How's that? Okay.
Good. Thank you all for indulging me.
It's no problem at all.
No, that's fine.
Actually, I usually come back and report to you what we did with tax investments anyway, so it's very easy to fit that into the notice, into the information. I think we adjusted the rating categories here for bond funds.
They're up from AA?
It's just clarifying it should be AAAF for bond fund. It's just
Oh, I
correcting
see,
the,
just the F.
yeah, it's just an F at the end. And here's where we have local government investment pools. So this is where we've adjusted this to account for Florida Prime, which is the old SBA.
Yeah.
We may invest in intergovernmental funds, including the Florida Local Government Surplus Pool, Florida Prime. And the treasurer may invest in Florida Prime only if the fund management is outsourced to a nationally recognized money management fund. That was what you all had requested last time. So I've got that fit in here, that's the only way we would do it. So if it went back to just the state managing it, we would not use it.
Is there any other standard for a money market fund, a rating or something like that?
I think we have that requirement. Yeah, it's right here, AAAM
Okay, good.
or AAAF.
All right, good.
We also have, the maximum is bumping up to 75, and we have talked about this before, bumping it up to 75, and the maximum 75 should be used sparingly with a goal of 50% or less invested in intergovernmental pools. And we had talked about this before. This isn't a new change, but it still hasn't gone to the board, so I wanted to share that with you. So it's going up from, it's interesting, it says 25 here and it says 50 here. I'll have to go back to see what is in policy right now. I believe it's 50%. Right now, we can have up to 50% in pools. No more than 25% with any individual issuer.
That means any pool, correct? Any particular pool?
Right. It's with issuers, and this is actually something that we've been talking about, that Richard and I have been talking about. Florida Palm has the liquid pool that we invest in. They also have what's called a term pool, where you can use that and say, I want to invest $20 million for 75 days. And they buy securities to fit into that pool for it to mature that date. So it's not liquid, it's not overnight. If you were to pull the money out sooner, you would pay a fee for the difference. That is a great alternative to doing separately managed accounts because there's no fees associated with it. It's all embedded in the cost, and they have very attractive rates. Right now, I'm looking at that as the individual issuer is still Florida Palm. Whether it's liquid or term, it's all Florida Palm. So we can have no more than 25% between those two pools. That's how we're looking at it right now. I would really like to put more in that term pool because it's very attractive rates. And we don't have to pay for custody. We don't have to pay for some of the fees that we have for the separately managed account. But we run into the issue here that it is the issuer. And really, the issuer, it's all managed by PFM. So in theory, if there's a problem with term or the liquid pool, it would be with both. So it really is a protective feature. That's why I didn't ask for a change. But we keep bumping up against this limit with that term product. But this does put a limit in there. The pools also, for just extra information so you're aware, Florida Palm imposes a limit that no more than, well, an issuer can have no more than 15% of the whole pool. They don't want us to ever be 25% of all the investments in that pool. They want a well-diversified pool, so they limit it. So I've had an instance where I was putting money in and was told, nope, you're over the limit, you can't do it. Okay, that's good. I don't want to be there.
That's the Florida Prime. How about the others?
Florida Palm, just so you know, that's up to, what's the total amount invested there now? We just heard it.
You mean the total overall fund?
Yeah.
6.5 billion.
It's gone to six, that's the one that we helped build, so it's up to 6.5 billion invested. It's a much bigger pool than, it's grown significantly over time.
I think my question is, are there other pools besides the Florida?
There is Florida Prime, Florida Palm, and then there's a couple more. A firm called Deep Blue runs a couple of funds.
Yeah.
And we're looking at those right now. I went on their website. I want to make sure they're compliant with GASB 79.
These are the only two we have in this
We're
policy,
only using two right now.
and that's part of the policy.
No, we can use any one. The local government investment pools, they're limited to, we have to use ones in Florida. You can't go out of state.
Right.
So there are some others that I'm looking at. Deep Blue is knocking at the door regularly and would like me to use theirs. I'm still doing some due diligence to make sure they meet my standards of what I want to invest in. I would like to have another one. Richard probably would like me to say no to that, but I'd like to have another to be able to spread it around. Diversification is important. We've learned that. So
You're going to all have a AAA-M or whatever.
yeah, I want to make sure they have the right rating. I want to make sure that they have the reporting that they're compliant with GASB 79. Whenever we're investing, and we're going to get to this in just a second, I think that's really the last change, but I want to show you, other than, district capitalization type of things, I think that was the last change. Yeah. So down at the end, there is a glossary, and I'm going to skip over that. We're not making changes to the glossary. But down at the end, there is a money market / local government investment pool questionnaire. And we fill this out whenever we start using a new pool, and we also update it at least once a year. And it's attached as part of the annual investment report, so it's documented. And we ask all these questions, and we get the backup for all this, for these questions. We want to make sure that we understand how the pool works, and if things have changed, we want to make sure we're monitoring that at least annually. We use this for money markets and pools. So we go through the prospectus, we go through the documents. If we can't find it, we're making phone calls, show us where this is in your documents. So we're updating it every year. So for each pool and money market, the annual reports, we'll have those for you in December. That's one of the attachments, are the completed questionnaires. We attach this every year. Because we want to make sure we understand. I lived through the problems with the SBA. I know it can happen bad. We want to make sure that we're staying on top of how these funds are being managed. I know I'm very familiar with Florida Palm just because I'm on that board, and I get to see that, and I get to see that they give great market updates, and I get to see behind the curtain. I see where they do stress tests every month and how much of a market move it would take for it to really impact the investor. That's great knowledge to have and to help me be more comfortable with that pool. When we're going into another pool, I don't have the same access. So that means I'm asking a lot of questions before I go into another one. I see a question coming. Is there any questions?
I have a statement. The last time we had a reference to this, in big capital letters, was by Bill Moore, when he said, how fast can we get
Ancient
out?
history now.
And we get out by 9 a.m.
And we pulled money
Just
out.
before this meeting was out.
We did it here at the meeting. We pulled it up on the screen and did it.
Took our toys and went home.
And
Yeah.
we saved a lot of money.
Yeah. Okay, any questions, any other issues with the investment policy? If not, I'm going to move to the debt policy.
Okay.
Okay.
Do you want a motion first to approve?
Oh, yes, thank you.
Motion to approve as presented?
Is there a second?
Second?
Any comment? All in favor?
Aye.
Aye.
Any opposed? None?
Okay, thank you. The debt policy, I don't think there was any changes here. Oh, wait, it's not showing. There was at least a date change. It keeps defaulting to not showing the changes.
What?
Okay, so there's some minor changes. You've seen these before. So when we talked about, we had qualified zone academy bonds, and we've expanded that to say federally subsidized bonds, and then in parentheses, QZABs, QSKIBs, and BABs. This is just talking about the different types of debt that exists. The permissible debt, there is a sentence here. recognizing it's an integral part of managing it to allocate the cost of capital assets over time to constituents that benefit from the assets. Short-term debt, there's some clarification. This is not new, but that it's generally less than 1 year for short-term. And certain bond anticipation notes and revenue anticipation notes may go beyond a year. You know, they can be a year and they can roll over for another year. They can go up to 5 years, but they're individual one-year notes. So it's just clarifying what they are. Added the state of Florida for Florida laws. And then for COPS, this is just clarifying language. And wow, there's a spelling error right there that I'm going to fix while we do this. We added a sentence that the goal to have no more than 50% of the local capital outlay levy used for debt service. It doesn't include COPS that are going to be repaid with other sources such as sales tax or impact fees. I'm looking for anything that's most of this is very minor language changes. Change of the word developed to implemented. Adding most cost-effective financing instead of longest long-term effective financing rate. A lot of this is just language trying to make it read better. And that's really it. Let's see, we changed the dates for the ratings. By the way, I did talk with Moody's yesterday and Fitch on Tuesday, getting ready for this debt issue. So we will be getting rating reports sometime in November. So when those come out, I can let you know. But the calls went really well. Under credit enhancement, we added if credit enhancement is required for the type of financing employed. So a lot of this is, just clarifying language. I don't view any of this as being really material.
So lowest cost bidder, is that a term that replaces highest bidder? Highest and best bidder?
Where are you at?
I'm on long-term debt B, section 7, the changed language you have there.
I think that one was a correction. Instead of highest and best bidder, it's lowest cost.
Okay.
Just trying to make it a little clearer.
Is that a standard language? Because
I think that's pretty standard, and Laura Howe from PFM, she helped me review all this.
Yes, that's standard language, and in any resolution that would be approved by the board, it would be based on the net interest cost or the true interest cost, depending on the type of competitive sale. So it is the lowest result of that comes in for a competitive bid.
okay.
I was just looking to see, again, most of this is very minor language changes. To achieve, instead of to achieve savings, it's now to achieve net interest cost savings. It's just clarifying language.
Okay.
When it comes to, we added some extra language regarding hedges. The district can add to the underwriting team to ensure a large enough pool of candidates to aid in obtaining favorable financing terms if we were doing hedges, which we're not in the market for doing hedges these days, but we wanted to clarify the language there. We added if applicable. There's not a lot of changes here. We've been looking at the investment and debt policies, and the language for the money market is new. We just added that in. But otherwise, this is language you've been talking about for several years. These policies have not been reviewed by the board since 2017. They need to see them, even if they are very minor changes. It's just been too long. So I wanted to make sure that we reviewed them. If any tweaks need to be made, we did that, and get these in track to move forward to the board. Are there any questions on the debt policy?
Yeah, another one, and this Bill may be able to chime in. And
No?
when
No,
there's a reference,
not for me.
go ahead, Bill.
No, nothing.
There is a reference here, though, in, I think it's prudently hedge risk in the context of particular financing. I think it's basically through interest rate caps, basis swaps. And forward delivery swaps. Those can be all very risky. Do we have risks on, remember how swaps kind of crushed that market we were talking about? Is there any limitation here? Because swaps and interest rate caps can cost you money.
Well, we had a period of time where we were actively doing swaps.
Yeah.
We are not in the market to do any swaps at this point.
Right.
But it's in the policy. It's not a bad thing to have it in the policy before we do any debt-related transaction, including swaps. They all come into the Finance Committee.
Well-
And you all do a great job at vetting them. But having the ability to do them, having it in the policy that is something we could do, assuming we go through a very thorough review and approval process, which is what we always do here, and then it goes into the board, this just leaves the language in there. These aren't really, we don't have very many changes here. But this has been here for years. I mean,
Basis swaps?
And Leanne, in the guidelines, we did change the percent, because the debt guidelines, which I think
Okay, we haven't
we'll
got
go
to
over
those yet.
next, we did have percent guidelines in there as well, and those were updated, but this is just,
Yeah, let me flip over to the guidelines for just a minute, because Laura's right. That's another document. The policy is what goes to the board, and that's that's the document that governs everything.
Right.
But we also, for debt, we have guidelines and we have procedures. So the guidelines are reviewed by the Finance Committee, and we can make changes as needed at the request of the Finance Committee. So when we get down to, we've got some, the changes here are very minor. I found the word of instead of or. It's, this is credit ratings this is breaking out, this table talks about the method of sale, when you'd use a competitive sale and when you'd use negotiated sale. And it has a lot of different categories, related to the issuer, the credit quality, market guidelines. And there's been some clarifications here and corrections that were made. But I'm going to scroll down. There are some changes here. And this document can be changed whenever we want. I can bring this back and we can update this every 6 months if you like. This is where we do get really into the weeds. And I'm going to move ahead to, for instance, for variable rate, it was 50%, it's now to 25%. And at any point in time, no more than, it was 25%, now 10% of the district's debt will be unhedged variable rate transactions. And there's a whole section here on swaps. Well, this is when we get into it. Qualifications of swap counterparties. There's no changes in this. I think we made changes last time. And is it showing? Yeah, it is. For swaps, at the time the district enters into hedge, no more than the greater of $100 million or 35% of the total principal amount hedge obligations should be with a single counterparty. And it talks about considerations of the district swap portfolio is a small portion of the debt portfolio. Diversification may not be cost effective. This is where we've spent a lot of time with the committee in the past going through and adding a lot of additional requirements regarding swaps and debt. This gets more into the weeds than the policy needs to have. And this can be edited and changed at any time where the policy goes through 3 workshops with the board with advertisements. So I try to keep the policy at high level to cover the level of detail that needs to be in policy. And then, especially with debt, we have this extra document that gets more into the weeds, talking about the events of default that need to be in the documents when we do a transaction. I think this is getting more into some of your points, that we're covering all this in great detail.
Well, I guess the question is how you all feel about swaps.
I guess, well.
We faced that.
Well, they'll go back in style again at
They come
some
back
point.
down there.
I don't know. I would depend on you to tell me that.
I haven't seen them for years.
If I asked our CFO to opine, and I'm not going to ask her right now because I'm going to speak for her, but she's happy to chime in, she hopes we never do another swap again.
Yeah.
Well,
When
this is
swaps,
wide
we
open.
did them, they were very effective. We saved, I believe it's over $40 million. It was very effective, but there were problems with it when you had the market meltdown.
Heartrending.
And as a result, a lot of the reporting requirements changed. it's very onerous and very challenging to have a swap right now. We have no appetite to enter into one of those. And if anybody sends them to me, I just say, we're not interested in swaps at this time.
Is there percentage risk? I mean, is there percentage limit here as to what can be in swaps or that type of?
I don't think there is a limit in the policy. I think when we move over to guidelines, it talks about there's limits on the variable rate, amount of variable rate, and the amount that can be unhedged.
So the amount of variable rate would limit the swap, I guess,
Right. There are rates,
unless you switch from variable to fixed.
it gets into very,
Such a painful period.
I know, that's right.
you know?
Yes, I think the people, at least those of us who've been around for a while, don't want to don't have no appetite
No
for it,
appetite.
for sure.
well, let me switch over to PFM. What if we just took all the language for swaps and just deleted it from the policy? What's the risk if we were to say we're taking it all out?
From the policy and not the guidelines as well. If a potential was to come up, then you would have to revise that and bring it to the board in order to enter into any sort of agreement, so.
Well, what's the value at this point in time? Is it worth the risk? That's really the question.
The way
What's
I
the
look
risk?
at it, the way I look at policies are giving us a toolbox of things that we could do. Not that we will do, but these are tools that are available that have been vetted and approved that it can happen. Every transaction we do regarding debt, everyone has to come to the Finance Committee and go to the board and be approved individually. I do not have the ability to enter into a swap. We have no desire to enter into them. Having the language in the policy, though, I think that gives guidelines that if the market were to change, I don't think I'm going to do a swap before I retire. It's not going to happen while I'm here. It's not going to happen while Heather is here. However, when we leave, this policy still exists and is there for new people. The policy is
Right.
going to outlive all of us.
Right.
So having the language there and the benefit of the experience of what we went through, I think is valuable.
Yes, I agree. I don't
Okay
have
with
any choice, I don't have
Okay.
any
You all-
desire to take it out. I mean, it's another,
Never
as you
say
said, another tool that maybe it'll become fashionable again at some point.
There are some clients who are using it as like a forward starting swap for just a short period of
Yes,
time, not that, so I think the ability to leave it in case there's a need that the district comes up with that we're not anticipating now would allow for that flexibility to potentially lock in rates or do a refunding that might be considered a
That's what we're
swap.
talking about,
Right.
Yeah.
locking in the rate.
It could be locking in the rate.
Yeah.
It wouldn't be the basis, the swaps that we did years ago. It would be some other variation of it that may be short-term, locking in a rate, waiting, because you can't do advanced refundings anymore. So it may be a short-term swap that gets us to the point that we can do the refunding.
Okay, that's.
It just leaves the language in there to benefit from what we've all learned.
Richard, how do you feel? Well, you're the man. Your firm, David Moore, cued us in.
Yeah.
Your president.
Well, we've got PFM is split into two different companies now. So he's on the asset management side and Laura's on the debt, the financial
Okay,
manager
Laura.
side.
Laura.
So the feeling, what's the feeling there?
Yep. Okay, so we have the policy and the guidelines. The other document that I have, which is something that I can change, but before I ever change it, I bring it into this committee, and I don't have any changes other than date. This is the debt compliance procedures, and this is posted on our website. This is something that is required, that we have this in written form. I don't have any proposed changes here.
I think the only change was the verbiage for the annual financial report under
Oh,
annual finance.
That's
Very minor,
correct.
yes.
And let me make sure this is turned on again. The annual financial report used to be called the CAFR, the Comprehensive Annual Financial Report. Now it's the Annual Comprehensive Financial Report. The abbreviation changed. So we do see that throughout the document.
So do we need motion, Leah?
We do need a motion to accept all the documents.
Is there a second?
Second?
Any opposed? All in favor?
Aye.
Okay. So the only other thing on the agenda is to remind you the next meeting is scheduled for December 1st. And we-
December 1?
December 1.
This is the party?
That is the breakfast.
Good.
Yeah.
There's such thing as a free lunch, is that it?
If you have requests, see me later.
You do pretty well on your own on that one.
Yeah, that's right.
So,
I have just one item. It suddenly occurred to me over the summer that, and this is only, that I don't want anybody, I don't think there's anything about conflicts of interest, but we have increasingly number of large members of my family are in the securities business, nothing to do with the municipal bond business, and nothing to do with the money markets business at all. But I just want to be sure that you know, I don't know whether that's even a subject about which we should be concerned, but I mean, I have not, you know, I do have relatives in the business, and they are totally unrelated to anything that we deal with here on a routine basis. But
They don't live in your household.
no, they don't. No, they don't. Thank God they are all freestanding economic units.
Typically, that would
Right.
Yeah, they're-
not put them into the category.
Right.
Where you have any control of.
Yeah, no, I have no, they're not by no means.
Okay.
there is a conflict of interest, and there's actually a video that you can watch that goes through the rules. And I can send those out so you can take a look at them, but I don't think you
I
have an
can't-
issue, because
I
we've
don't-
talked about it before.
Well, it just occurred to me, we have one grandchild in the business now, and I think I'm about to have yet another one, and, you know, it suddenly occurred to me that, man, I'm sort of getting overlaid, but we've got to figure out some ways for somebody to make a living in the family other than the securities business, but.
They're following in your footsteps.
Yeah.
Yeah, well, but there is, we can actually, at December, that might be a good topic to put on the agenda, to do a review of the policy. We can go over that. It won't take very long.
Yeah, well, I
So we
just,
can do that. We haven't done it in a couple of years. It's
Okay,
been
well.
pre-pandemic. So we should be redoing that every once in a while. I just spied over to legal, and they were nodding. We can do that at the December 1st meeting. So that meeting we won't have quarterly reports. I'll probably give you an update on what we're doing with the investments. We wouldn't have received the money yet, but I can go over that. And we'll have the annual reports, the annual debt and investment reports. So it's really a light meeting in the scheme of things. That's why we have time to do breakfast, and we can bring that in and talk about it. I realize that there's one more policy we need to look at, the Finance Committee policy itself. I pulled that up to look at it thinking there were no changes, and there's some language changes. And so I've asked the legal team to look at it and review that to see. There's some things that need to be brought up to date with the district's overall policy on committees. It doesn't really impact what you're doing, but there's some language changes that'll be needed. So we'll bring that in at December 1st too. So we'll cover that for you.
okay, good, thank you.
Anything else?
Yes, the same question. If not, we're adjourned.
Okay, thank you very much.
Thank you.